Listen, I want you to picture something. A Tuesday afternoon in February of 2026. A conference room on the 14th floor of a law firm in downtown Minneapolis, Minnesota. Her name is Carolyn. She is 64 years old. She spent 28 years as a senior operations director for a regional insurance company. She understands insurance products better than most people in this country. She sold them, reviewed them, approved them, denied claims on them. She was not a naive consumer. She was an industry professional. And she is sitting across from a probate attorney who is explaining to her that the $2,200,000 death benefit from the group term life insurance policy her husband Leonard held through his employer for 23 years is not going to arrive at her doorstep as $2,200,000. It is going to arrive as something materially smaller, because Leonard did not own the policy. His employer did. Because the policy was held inside a corporate-owned life insurance structure. Because the proceeds, instead of passing income tax-free under Internal Revenue Code Section 101A, as Carolyn had always assumed, are partially taxable as ordinary income to the beneficiary under the transfer for value rules embedded in the same section of the code that everyone quotes as proof that life insurance is tax-free. Carolyn has spent 28 years in the insurance industry. She never had this explained to her. The attorney explains that the taxable portion of the death benefit, the amount above Leonard's basis in the policy, which in a corporate-owned structure is calculated differently than in an individually owned policy, is going to generate a tax bill of approximately $340,000. Carolyn drives home in silence. That is the life insurance tax trap. Not a theoretical risk, not an obscure edge case that applies to hedge fund structures and offshore arrangements. A trap built into 3 specific life insurance policy configurations that millions of American families hold right now, without understanding that the tax-free promise they were sold has conditions, exceptions, and exclusions that the agent who sold the policy almost certainly did not explain, and that the beneficiary almost certainly will not discover until the check arrives, and the $1,099 arrives 6 weeks later, with a number that does not reconcile with anything they were told. Today we are going to identify those 3 policy configurations. We are going to explain exactly why each one fails the Section 101A test for income tax-free treatment. We are going to model the tax damage in real dollars, and we are going to walk through what you can still do before retirement, before the first spouse dies. Smash the like button right now. The platform is suppressing content that explains life insurance tax mechanics in the context of retirement planning, because the life insurance industry is one of the largest advertising categories on every major platform, and the disclosure that certain policy structures produce taxable death benefits is not consistent with the marketing message that life insurance benefits are always tax-free. Every like on this video is a signal that breaks the suppression. Hit it now, subscribe, flip the bell, join the archive. The suits in legal want me to say this is not financial advice. Fine, this is not financial advice. This is a forensic examination of Internal Revenue Code Section 101 and what it actually says about when life insurance death benefits are taxable, which is more often than the industry acknowledges and almost always more than the policyholder knows. Consult a fee-only fiduciary and a tax attorney who has read the statute and the transfer for value regulations. What I can do is show you the 3 policy types, the tax mechanics, and the fix. Let me start with the foundation. Because Internal Revenue Code Section 101A1 is the provision that every insurance agent quotes when they say life insurance is tax-free, the statute says that gross income does not include amounts received under a life insurance contract if such amounts are paid by reason of the death of the insured. Income tax-free. That is the rule. Tax-free death benefit. It sounds absolute. It is not absolute. It has exceptions. Situation 1. The transfer for value exception under Section 101A2. When a life insurance policy is transferred for valuable consideration, the death benefit becomes partially taxable to the recipient. The taxable amount is the excess of the death benefit over the consideration paid for the policy, plus any subsequent premiums paid to a corporation in which the insured is a shareholder or officer, and transfers in which the transferee's basis is determined by reference to the transferor's basis, as in a tax-free reorganization. Outside those exceptions, a transferred policy produces a partially taxable death benefit. Situation 2. The employer-owned life insurance exception under Section 101J, added by the Pension Protection Act of 2006. Section 101J provides that death benefits from employer-owned life insurance policies are taxable as ordinary income to the employer to the extent they exceed the employer's basis in the policy. To the extent they exceed the employer's basis in the policy, unless the policy meets specific notice and consent requirements and falls within a narrow category of eligible insured persons. The notice and consent requirements mandate that the employee was notified in writing that the employer intended to insure the employee's life, was notified of the maximum face amount, and consented in writing before the policy was issued. Policies that meet the notice and consent requirement are still only fully tax-free if the insured falls into a specific eligible category at the time of death. Situation 3. The Modified Endowment Contract classification under Internal Revenue Code Section 7702A. A life insurance policy that is funded too rapidly relative to its death benefit is classified as a modified endowment contract, meaning the premiums paid in the first 7 years of the contract exceed the net level premium for the same paid-up death benefit. Once classified as an MEC, the policy loses many of its favorable tax attributes. Withdrawals and loans from an MEC are taxed on a last-in, first-out basis, meaning gains come out first and are fully taxable as ordinary income. The death benefit itself remains income tax-free under Section 101A for an individually owned MEC held to death. But the living benefits, the cash value access, the policy loans, the withdrawals, are all taxed as ordinary income and subject to a 10% early withdrawal penalty if taken before age 59 and a half. The MEC classification is the most common life insurance tax trap for the retiree who funded a cash value policy aggressively in their 50s and then attempts to access the cash value in retirement as a tax-free income stream. Now let me name the 3 specific policy configurations that produce these outcomes and model what they actually cost. Policy 1. The group term life insurance policy held through an employer under a split dollar arrangement or a corporate-owned structure. This is Carolyn's situation. This is the policy that sits in the benefits package of every executive compensation arrangement at every mid-sized and large company in the country. Group term life insurance up to $50,000 of death benefit is excludable from the employee's gross income under Internal Revenue Code Section 79. Above $50,000, the imputed income from the employer-paid premium is taxable to the employee as ordinary income, calculated using the IRS Table 1 rates. But the death benefit question is separate from the premium imputation question. If the employer owns the policy, the employer is the named policyholder, and the death benefit is paid to the employer with a separate agreement directing the proceeds to the beneficiary. Leonard's policy was a group carve-out plan, but Leonard's death at age 67, 1 year after his retirement from the company, means that he was no longer a current employee of the company at the time of death. Under Section 101J2B, the eligible insured categories include current employees, officers, directors, and highly compensated employees. Retirees are not in the eligible category. Leonard was not. His death as a former employee means the policy does not fall within the eligible insured category. The death benefit above basis is taxable as ordinary income to the employer. The employer's separate payment obligation to Carolyn as the named beneficiary is a corporate expense, not a tax-free insurance benefit. Let me model the numbers. Leonard's $2,200,000 death benefit, employer's basis in the policy, premiums paid over 23 years minus the term cost of insurance extracted by the employer, approximately $380,000. The employer's separate payment obligation to Carolyn as the named beneficiary is a corporate expense, not a tax-free insurance benefit. Let me model the numbers. Leonard's $2,200,000 death benefit. The employer nets $2,200,000 minus $382,200 equals $1,817,800 before paying its separate contractual obligation to Carolyn. Depending on how the split dollar agreement is structured, she may receive a reduced amount. The specifics depend on the plan documents. But the tax event at the employer level is real. Tell me in the comments right now. Tell me whether you or your spouse has a group term life insurance policy. Tell me whether anyone has explained the employer ownership structure. Tell me your state and your approximate policy face amount. Drop it in the comments. I read every single one. Policy 2. The transferred life insurance policy purchased from a third party or received as a business transition asset. This is the transfer for value trap, and it catches small business owners, buy-sell agreement participants, and anyone who has acquired a life insurance policy through a business transaction. Here is the scenario. 2 business partners, Marcus and David, execute a buy-sell agreement funded by cross-owned life insurance. Marcus owns a policy on David's life. David owns a policy on Marcus's life. Each policy has a $1,500,000 death benefit. The arrangement funds the business succession plan. If one partner dies, the survivor uses the death benefit to purchase the deceased partner's interest from the estate. The arrangement is common. The arrangement is sold by every business insurance specialist in the country as a clean, tax-efficient succession solution. Here is the trap. Marcus and David's company grows significantly over the next 15 years. They decide to shift from cross-owned policies to entity-owned policies, meaning the company itself will own the policies rather than the individual partners. This requires the partners to transfer their policies to the company. Both transfers are for valuable consideration because the company assumed the remaining premium obligations in exchange for the policy ownership. The transfer for value exception that would have preserved the tax-free treatment applied when the partners owned the policies directly. The company is not a partner of either insured. The company is an entity. The transfer to the entity does not qualify for the partnership exception. The transfer for value rule now applies to both policies. When Marcus dies 10 years later, the company collects the $1,500,000 death benefit. The company's basis is the consideration paid plus premiums paid since the transfer, approximately $420,000. The taxable ordinary income to the company on the death benefit is $1,500,000 minus $420,000 equals $1,080,000. At the 21% corporate tax rate, the company owes $226,800 in federal income tax. The after-tax amount available to fund the buy-sell agreement is $1,273,200, not $1,500,000. The business succession plan was designed with a $1,500,000 death benefit assumption. The actual proceeds are $226,800 short. The surviving partner either funds the shortfall personally or acquires a smaller percentage of the business than the buy-sell agreement specified. The transfer for value problem is not exotic. It is the predictable consequence of a policy restructuring. The fix for a transferred policy is available before the insured dies. If the policy can be transferred back to a qualifying recipient, the taint is eliminated. Specifically, evaluate whether the insured can purchase the policy from the current owner for fair market value. The insured purchasing the policy, on his own life, qualifies for the exception. The tax-free status is restored. This restructuring requires a formal policy valuation, a documented purchase transaction, and coordination between a tax attorney and a CPA. It is not a 10-minute phone call, but it is far less expensive than the tax event it prevents. Policy 3. The overfunded cash value policy classified as a modified endowment contract. This is the retiree's trap, the one that catches the financially sophisticated person who learned in their 50s that cash value life insurance can function as a tax-advantaged savings vehicle and who funded a whole life or indexed universal life policy aggressively in the years before retirement with the intention of accessing the cash value as a tax-free income stream in retirement through policy loans and withdrawals. Here is what the agent told them. You can take loans against the cash value tax-free in retirement. The agent was describing a properly structured, non-MEC whole life or indexed universal life policy that is funded within the parameters of the IRS's 7-pay test under Internal Revenue Code Section 7702A. The agent was not describing what happens when the policy is funded above the 7-pay limit. The 7-pay test says that if the cumulative premiums exceed the net level premium, the policy fails the test and is classified as a MEC. Once classified as an MEC, the classification is permanent. It cannot be reversed. Every future withdrawal and every policy loan is treated as income first, principal second. Every dollar above basis is taxable as ordinary income. The 10% early withdrawal penalty under Internal Revenue Code Section 72V applies to MEC distributions taken before age 59 and a half. Here is the real-world scenario. Meet Thomas. He is 59 years old. He is 3 years from retirement. In 2019, at age 52, he sat across from an insurance agent who showed him a policy illustration for an indexed universal life policy with a $1,800,000 death benefit, who learned in their 50s that cash value life insurance can function as a tax-advantaged savings vehicle and who funded a whole life or indexed universal life policy aggressively in the years before retirement. Here is what the agent did not show him clearly. The 7-pay limit on Thomas's policy, was approximately $62,000 per year. Thomas was funding the policy at $80,000 per year. He exceeded the limit in year one. The policy was classified as a modified endowment contract before the second premium was ever paid. Thomas has now been funding an MEC for 7 years. His total premiums paid are $560,000. His gain inside the MEC is $80,000. The agent showed him a scenario where he puts $80,000 per year into the policy for 7 years, and then takes tax-free loans of $120,000 per year in retirement for 20 years. Thomas signed the application. Here is what the agent did not show him clearly. The 7-pay limit on Thomas's policy was approximately $62,000 per year. Thomas was funding the policy at $80,000 per year. He exceeded the limit in year one. The policy was classified as a modified endowment contract before the second premium was ever paid. Thomas has now been funding an MEC for 7 years. His total premiums paid are $560,000. His gain inside the MEC is $80,000. If Thomas takes a loan of $120,000 from the MEC in retirement, the first $80,000 is taxable as ordinary income because gains come out first in an MEC. The remaining $40,000 is not taxable. He borrowed $120,000 and has $80,000 of ordinary income. At the 22% federal bracket plus Minnesota's flat 9.85% state income tax rate, his combined marginal rate on the $80,000 is 31.85%. His tax bill on the loan, approximately $25,480. He took a $120,000 loan. He netted $94,520 after tax. The tax-free retirement income strategy the agent illustrated is generating a 21.2% tax on each dollar of retirement income above the basis. Over 20 years, the cumulative tax will be substantial. And the death benefit, the $1,800,000 Thomas planned to leave to his children, remains income tax-free at death under Section 101A. The MEC classification does not affect the death benefit tax treatment for an individually owned policy. It only affects the living benefits, the cash value access during Thomas's lifetime. The trap is not the death benefit. The trap is every dollar of cash value access Thomas takes, based on a tax-free illustration that was accurate for a non-MEC policy. Now let me give you the 3-step fix. Because each of the 3 policy types has a different intervention, and the timing of each intervention determines whether the fix is still available. Fix 1. For the group term or corporate-owned policy, before retirement, verify the ownership structure of every employer-provided life insurance policy with a death benefit above $50,000. Ask HR for the plan documents. Ask specifically whether the employer is the named policyholder. Ask whether the policy was subject to a Section 101J notice and consent procedure. Ask whether the insured qualifies as an eligible insured if retirement precedes death. If the policy does not qualify for full income tax-free treatment after retirement, explore whether the policy can be transferred to individual ownership before retirement. A transfer to the insured falls within the transfer for value exception. The employer may or may not permit this transfer, and the policy valuation at the time of transfer determines the consideration paid. But the option is worth exploring with the benefits department before separation from service makes it harder. Fix 2. For the transferred business policy. Identify every life insurance policy involved in a business succession arrangement that has been transferred since the policy was originally issued. Ask the agent or the policy administrator whether a transfer for value analysis was done at the time of each transfer. If no analysis was done, assume the transfer for value rules may apply and engage a tax attorney. If the taint exists, evaluate the cost-benefit of restructuring the policy ownership to restore the Section 101A(1) exception. Specifically, evaluate whether the insured can purchase the policy from the current owner for fair market value. The fair market value of a life insurance policy is not simply the cash surrender value. It includes the actuarial present value of the anticipated death benefit, the health status of the insured, and the remaining premium obligations. A formal policy valuation by a qualified appraiser is the correct starting point for any policy restructuring designed to eliminate transfer for value exposure. It is far less expensive than the tax event it prevents. Fix 3. For the modified endowment contract. The MEC classification cannot be reversed. Once a policy fails the 7-pay test, it is a modified endowment contract permanently. The available fix is not remediation of the classification. It is structural planning around the tax consequences of distributions. If Thomas owns an MEC, his immediate priority is to avoid taking MEC distributions until he has exhausted every other available source of retirement income. The MEC distributions are most tax efficient when taken in years of lowest other income. The death benefit on the MEC remains income tax-free. If Thomas never takes distributions, the entire cash value grows tax deferred. Now let me give you the geographic dimension. In states with no income tax, the MEC distribution tax is federal only. Thomas in Texas pays the 22% or 24% federal bracket on MEC gain distributions and nothing at the state level. The same MEC distribution in Minnesota costs 31.85% combined. The geographic differential is the full state income tax rate. For a high-tax state like California or New York, the state adds a significant layer of cost. For the corporate-owned policy and the transfer for value policy, the geographic dimension affects the corporate or entity-level tax, which varies from 0 in states like Nevada to 8.84% in California. The total tax on a corporate-owned policy death benefit in California includes the 21% federal corporate rate plus the 8.84% California state corporate rate for a combined rate approaching 30% on the excess death benefit above the basis. That combination, applied to a $2,200,000 death benefit like Leonard's with a $380,000 basis, produces a corporate tax bill of approximately $552,000. The beneficiary's net benefit depends entirely on the contractual obligation. Save this video to your private library right now. Hit the save icon. Label the playlist Retirement Survival, because the life insurance tax trap is the financial event that arrives with no warning signal. The quarterly policy statement shows the cash value, the death benefit, and the credited interest rate. It does not show the MEC classification. It does not show the transfer for value taint. It does not show the Section 101J analysis. It shows a number and an assumption that the number will arrive tax-free when the time comes. And the assumption is wrong for 3 specific policy configurations that are sitting in the portfolios of millions of American families right now. Subscribe if you have not, flip the bell, join the archive, comment with your policy type, your approximate death benefit, and your state. Tell me whether your policy was issued by your employer or purchased individually. Tell me whether you have ever received a transfer for value analysis from your agent or attorney. Tell me whether your cash value policy was funded within the 7-pay limit. We build the exposure map together in the comments section. I read everything. The life insurance industry sells a promise of tax-free wealth transfer. The IRS has written 3 specific exceptions to that promise into the statute. The exceptions are published. The regulations are available. The cases are documented in tax court decisions going back decades. The information is not hidden. It is just not disclosed at the point of sale, at the annual policy review, or at the enrollment desk where the administrator hands you the form. Carolyn spent 28 years in the insurance industry. She never had this explained to her. If she did not know, the assumption that you know is a dangerous one. Check the policy documents. Ask the transfer for value question. Verify the MEC status. Confirm the employer ownership structure before retirement. Do it before the check arrives with the wrong number attached and the $1,099 arrives 6 weeks later with an explanation nobody prepared you for. I will see you in the next one. Stay strategic. Stay furious. The Section 101 exception was written to protect families. The 3 carve-outs inside it were written to protect revenue. Know which side of the line your policy is on before death makes the question academic.